Next right, we have the voting rights. So the investor's ability to direct relevant activities of an investee is normally through voting or similar rights. So when an entity has voting or similar rights in respect to another entity, an entity should consider whether those rights give it the current ability to direct the relevant activities of the other entity. So normally, the investor's ability to direct the relevant activities of an investee is normally obtained through voting or similar rights, which consist of four factors. First, we have the power with a majority of voting rights. So an investor that holds more than half of the voting rights of an investee is presumed to have power over the investee, except when this is clearly not the case. So holding more than half of the voting rights result to power when the relevant activities are directed through major vote, or the majority of the members of the governing body that directs the relevant activities are appointed through majority vote. So next, we have the majority of the voting rights but no power. So an investor does not have power over an investee, even if he holds more than half of the voting rights, if the right to direct the investee's relevant activities is conferred to a third party who is not an agent of the investor. For example, the investee's relevant activities are subject to direction by a government or a court administrator, receiver, and liquidator or regulator. So next, we have the power without a majority of the voting rights. So an investor can have power even he holds less than a majority of a voting rights of an investee. For example, through a contractual arrangement between the investor and the vote holders, or the right arising from other contractual arrangements or the investor's voting rights. Next is we have contractual arrangement with other vote holders. So a contractual arrangement between an investor and other vote holders can give the investor power if the contractual arrangement gives the investor first the right to exercise the voting rights of the other vote holders sufficient to give the investor power, or the right to direct how other vote holders vote to enable the investor to make decisions about the relevant activities. Next slide, please. Okay. Next, we have the potential voting rights. So an investor with a current ability to direct relevant activities has power, even if its rights to direct have yet be exercised. So this is true in the case of potential voting rights. So accordingly, when assessing whether it controls an investee, a parent shall consider potential voting rights that are currently exercisable, irrespective of management intention or financial ability to exercise them. So potential voting rights includes share warrants, share call options, debt or equity instruments that are convertible into ordinary shares, or other similar instrument that, if exercised, have the potential to give the entity voting power or reduce another party's voting power over an investee. So potential voting rights are not currently exercisable if they cannot be exercised until a future date or until the occurrence of a future event. However, during consolidation, non-controlling interests are determined on the basis of present ownership interests and do not reflect the effect of potential voting rights. So, potential voting rights are considered only for purposes of determining the existence of control, which in turn determines whether an investee should be consolidated. And that would end my report. Thank you.
Next is substantive removal and other rights held by other parties. Removal rights are rights to deprive the decision maker of its decision-making authority. Such rights are considered when evaluating the decision maker as a parent or an agent for other parties. A decision maker that is required to obtain approval from small numbers of other parties for its action is generally an agent. If the decision maker is an agent, it does not control the investee. Next is exposure or rights to variable returns. An investor is exposed or has the right to variable returns if its return from its involvement with the investee vary depending on the investee's performance. The second element of the three elements of control, which focuses on variable returns. Variable returns that are not fixed and have the potential to vary as a result of the performance of an investee, such as dividends, interest, and bonds issued by the investee. So the principal should have a exposure or rights to variable returns sa investees. Next is ability to use power to affect investors' return. The investor's ability to use its power to affect its returns from its involvement with the investee provides the link between power and variable returns. It means that an investor controls an investee not only if she or he has power and exposure to its returns, but also the ability to use its power to affect its returns. Only if this ability is present along with power and exposure or right to variable returns does the investor obtains and control over the investee. Next is the accounting requirements. First is the reporting dates. The parent and subsidiaries' financial statements are drawn up to the same reporting date for consolidated purposes. If a parent and a subsidiary reporting periods do not coincide, the subsidiary shall prepare financial statements that coincide with the parent's reporting period before consolidation. Example is, if parent company is preparing his consolidated financial statements using calendar year, while the subsidiary is preparing his financial statement by fiscal year, the subsidiary should adjust should be coincide with the parent company reporting date. Next is, if this is impracticable, the subsidiary's financial statements are used for consolidated purposes with adjustment for significant transactions or event occurring outside the period covered by consolidated financial statement. In this situation, the difference between the subsidiaries and parent reporting dates may not exceed 3 months. It happens only if the subsidiaries' transactions are material to the company's consolidated financial statements. Next is the uniform accounting policies. It shall be used if the subsidiary uses different accounting policies. Its financial statements need to be adjusted to conform to the parent's accounting policies before they are consolidated. Example is, if the parent's company use FIFO and the subsidiaries use LIFO, the subsidiary should adjust his accounting policies in coincide with the parent accounting policy, which is FIFO. Next is consolidation period. Consolidation begins from the date the investor obtains control of the investee and ceases when the investor loses control of the investee. Next is measurement. Income and expenses. The income and expenses of the subsidiary is based on the amount of the assets and liabilities recognized in the consolidated financial statements at the acquisition date. Next is the investment is subsidiary. They accounted for in the parent separate financial statements either at cost, in accordance with FRS 9, and using the equity method. So, measurement at cost. It is initially measured equal to the value assigned to the consideration transferred at the acquisition date and subsequently measured at the amount unless investment become impaired. Measurement in accordance with PFRS 9. It is initially measured equal to the value assigned to the consideration transferred in the acquisition date and subsequently measured at fair value. Next is the measurement using the equity method. Initially measured equal to the value assigned to the consideration transferred at the acquisition date and subsequently increase or decrease for the investor share in the changes in the investee's equity. So the investment in subsidiary is for all the measurement is the same. Next is the next reporter, please.
Next is the non-controlling interest, which is also known as minority interest. That is an equity in subsidiary not attributable directly or indirectly to a parent. Non-controlling interest arises in a business combination in which parent acquires less than 100% interest of the subsidiary, or when the subsidiary is not wholly owned by the parent. Non-controlling interest is measured at either fair value or NCI's proportionate share of acquirer's identifiable asset. Next is the net and non-controlling interest in the net assets of the subsidiary. It is presented in the consolidated statement of financial position with an equity separately from the owners of the parent. Next, NCI in the net assets of the subsidiary consists of the amounts determined at the acquisition date using PFRS 3 that is either B fair value or the NCI's proportionate share of the acquirer's not identifiable assets, then the NCI share of the changes in equity since the acquisition date. Next, non-controlling interest in profit or loss and comprehensive income. The profit or loss on each component of other comprehensive income in the consolidated statement of profit or loss and other comprehensive income are attributed to the owners of the parent and the NCI. And the proportion allocated to the parent and NCI are determined on the basis of the present ownership interest. We also have to take note that the total comprehensive income is attributed to the owners of the parent and to the NCI as well, even if these result to the non-controlling interest having a deficit balance. Next slide, please. Next slide, please. Preparing consolidated financial statements. Consolidated financial statements are prepared by combining financial statements of the parent and its subsidiaries line by line by adding together similar items of assets, liabilities, equity, income, and expenses. Next slide, please.